Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, what we're going to go to our trade calculator tool. And let's go ahead and enter a trade. Now, I'm purposely not going to use the currency that we are using right now because I don't want to be giving out recommendations. If you do have questions on this, call me and I can give you some of my, I can see how currencies could fit into your portfolio if you want to talk about this on a one-on-one level. But what you can do, let's say, for example, that I am bearish on the US dollar. Now, what I'm going to do, I'm going to enter EUI. That's the symbol for the underlying for the euro. So let's say, for example, I think that the dollar is going to go down versus the euro. With that being said, what we can do is a diagonal spread. And let's go ahead and go out to December. And since I think that the dollar is going to go down, I'm going to buy a put option. The FX options, it's pretty cool from the standpoint that they're all dollar-based. Now, with that, like I said, this is not my specific opinion. I'm just doing this to show an example. I have a portfolio.
Right. We could actually turn it around also, Mike, right, in 3 minutes or 1 minute and just show dollar bullish, just to try to create a balance that we're not giving any recommendations here.
Okay, yeah, absolutely. If we need to do that, we can definitely do that. So with that, I'm going to go ahead and buy 10 contracts of the at-the-money put option to show that I'm bearish on the dollar, let's say, bearish on the dollar versus the euro. Now, with that, let's say that as we're doing that, I don't want to pay that much in premium, and I'm concerned with the near-term time decay risk, and I kind of want to hedge myself a little bit with volatility risk as well as the time decay risk. Well, for the near term, one thing that we can do is sell some premium. So let's say that I want to, let's actually go out to October, and let's say that I want to get, I will sell the 68.50 put. And what we're going to do is sell that option. We're going to sell 10 contracts of it, and I'm going to click Calculate. Once again, this is the trade calculator on the Brokers Express website.
Which one did you buy, Mike? I'm sorry. Which put did you buy, the longer dated one?
The longer dated put, we bought the December of 2009 69.50, and we sold the near term 68.50 put for
Gotcha.
October. So with that, to kind of give you an idea as to how this can work, this is based upon what mathematically has to happen on October 16th. Now, we don't know what's going to happen. No one ever knows what anything's going to happen ever. But with this, in the near term, let's say that the value goes to a level of 68.50. That is our peak point. That's like our dream price for expiration in October. Once again, this is not the position that we're in, nor is it intended to be a recommendation. But with that, in this example, this would be our dream price. The overall risk of the trade, and you can see the potential profit for the near term is $700 approximately. The overall risk of the trade is $1,060. So let's say that you have a portfolio of $100,000 to $200,000. One thing that you may want to consider if you're concerned with the value of the dollar going down and the value of the euro going up would be a diagonal put spread on the EUI product. That way, you have exposure to the euro should the euro increase and the dollar decrease, and also you can actually sell premium against it. So with that being said, let's say that the euro does start increasing and EUI does start decreasing, like for this imaginary sentiment on this trade. Now, one thing that you got to ask yourself, what if EUI is at 68.50 and we still have like 2 or 3 weeks until expiration? Well, you're not going to be at that $698 profit if that's the case, because that near-term premium would be working against you. That's where adjusting the option comes into play and the importance of it comes into play. So with that, you need to have the ability to be nimble and make the adjustment if that's part of your plan. having a plan before you get into a trade is something that's very important. The way that one of the rules that we like to do when we're using currencies as a hedge is if it touches the short strike price, that's a red flag to us. It doesn't mean we're necessarily going to roll the option, but it does mean that we're going to take action most of the time. So with that, that's kind of how we would view the diagonal spread. Now, let's say that we're a little bit neutral for the near term, and we wanted to kind of get a little bit more premium for the near term. One way with which we could adjust it, we could go to October again and sell a put option at the same strike at the 69.50 level. So let's go ahead and adjust that.
So now you created a calendar, correct, Mike?
That is correct. Let me get this up and running. So now in this case, you'll see the risk-reward graph looks a little bit different, and actually, okay, with this, the bottom line of what I want to show on this, the cost of the trade is $700 as opposed to $1,000. So it depends on what your actual near-term sentiment is in terms of hedging yourself.
So there's always something good and something bad about every trade, correct?
Without a doubt, without a doubt. All right, what other questions do we have?
And I don't know if you want to show it, but obviously you could turn it around and do it in calls and create that little bit of an upward bias. If you had done calls, if you had bought like whatever, a 67 call and sold a 70 or something like that, you could have done that too. Do you want to show that real quick, Mike? Just to
Yeah, let's go ahead and do that.
Balance by a long-dated, slightly in the money and selling at the money to show how that would change it?
Absolutely. Let's do that. Let's go out to December again. And let's go ahead and buy the 69 call.
Okay.
And let's sell the October, we'll say the 71 call. So with this, we now have the diagonal spread again to where we are long the December 69 call and we're short the October 71 call. Now with this, I did this with, we went slightly in the money, so when you go slightly in the money, it's going to be a greater out-of-pocket cost to you as a trader. So that's one thing that you'll notice here. We have a little bit more risk on the table in terms of the actual dollar amount. Now, the advantage is we don't have as much time decay risk, but we are taking on a little bit more out-of-pocket risk because, as you said, Steve, it's kind of one of those things that you always have to do a trade out when you're doing different styles of trades. This would be if you had a bullish sentiment on the dollar versus the euro.
Right, correct. You know, it's interesting, Mike, because I give a lot of seminars myself, and people always think there's a holy grail, there's a best spread out there or a best strategy. And I like your approach because you're just basically saying, guys, there's many things out there. You have to select what's appropriate for you, whether it's a slightly, it's in the money, slightly in the money, at the money, out of the money, because there isn't any best lane to drive in, if you don't mind me using the metaphor of a 3-lane highway. There isn't any best lane, just like there isn't any best strike price to trade, correct?
That is correct. And I know that in the traffic around Chicago and New York, I typically pick the wrong lane anyway whenever I drive. So I try and take the train.
There's only one lane there. Great.
Yeah.
Yeah. You want to go back to the questions and let's see if we can answer all the questions.
Yeah. Let's go ahead and see if we can get that taken care of.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.